First of all, thank you so much, MITAoE and entire entrepreneurship development or e-cell of MIT. And congratulations for arranging this particular e-summit for all the youngsters, for all the professionals, all the freelancers out there. And yes, now for me, the topic is investors' perspective, and I'm going to share you different aspects, different elements, like what exactly investors expect from earlier startups, what exactly investors expect from any of the innovators before they invest. And here in this entire session, we are going to have a brief about the different funding channels or different nuggets of having an investment for earlier startup. So before we see, now even the institutions, they are coming with a great innovations, they are coming with great earlier startups. Even the students are right now focusing more on entrepreneurship as a career. And the kind of culture we had or we have seen in IITs and NITs across our country, similar kind of ecosystem is now being developed at all universities and institute level. So it's basically for students, it's a cool thing, or startup is a hype, or startup has reach that particular heights where everyone is talking about startups ideas. Everything is almost there, but on the same way, what we say is the failure rate of startup is more than 80%. So here we need to consider each and every part of this ecosystem. Okay, now when I say ecosystem, so there are different stakeholders of this startup ecosystem. So number one is startup founder or that innovator. Number two, the entire team of the startup. Number three is incubation center or incubator. Number four is startup accelerators, consultants, okay, government nodal agencies. And there comes a part which is most sensitive stakeholder, that is investors, because at certain stage or precisely at a growth stage, investors are the one who decides, who basically creates a decision making for any startup, at what scale we can have this particular idea or this startup. Okay, and in line with all the stakeholders, right, whatever we have discussed, right from startup founder to investor, the core part of this ecosystem for startup ecosystem, the core part or the middle part of this center part of this entire ecosystem is our customer. Okay, so even if you meet any investor, even if you meet any consultant innovator, always we need to remember that customer should be at our core part. Okay, so before I actually start this presentation, before I actually start this session, investors perspective, I want to share you one part. Don't run behind investors, run behind customers, run behind solving their problems. Investors will automatically attract your startup. Okay, so we have seen many of the startups who day and night are preparing to impress investors, and they are not at all caring about what customers or what consumers are exactly expecting, right? So here what I would rather suggest is run behind customers, run behind solving their problems. Okay, now for this session there are three nuggets for this session. Number one, I'll be sharing you what all trends are right now. Now see, COVID-19, before pandemic, after pandemic, there has much more opportunities, much more challenges in the entire startup space. But we should consider, or it is already considered by the entire world, that startup is the next big thing, or startup is the next sunrise industry for our entire planet. So here we need to see what are those gaps, what are those challenges through which you can start with your startup. So right now, based on that, even funding trends are now changing. So the funding or the investors, the interest of investors before COVID, it was in other segments or it was in other sectors. But right now, their focus, their area of interest for investment is completely different. So this is something like where the market is changing, or where thanks to the technology, which is basically changing the entire market scenario, we need to think that what are the funding trends. Okay, so I'll be sharing you all the funding trends after COVID, after this pandemic. Number two, I'll be sharing you all the funding channels for startups. right? So right from bootstrap up to venture capitalist, what are different funding channels? I'll be, in short, I'll share you all those funding channels. And number three is the core part of the session. That's what you're watching this particular session, that what investors look for, or what are the exact expectations, or what are the precise requirements of investors to go ahead with the funding. So yes, we should all proud of that. See, with 40,000, 40 plus 40,000 plus startups which we have right now in our Indian startup ecosystem, today we have more than 33 unicorns. And the prime objective of doing all these things is to create a job. So we could create more than 7.5 lakh jobs in the last 6 years, and thanks to these 40,000 plus startups in our ecosystem. And that's why we are right now, or India is today, a home to the world's third largest startup ecosystem after US and China. So yes, that we are right now looking at the mushroom growth of the startups in our country. And even during this 2020 entire year 2020, there were 7,200 new startups which were generated in last year, in only last year. So let's look into different funding trends. Okay. So now, considering last year 2020, this is just a snapshot where we had more than 800 funding deals where the angel investors, VCs, private equities, even institutional funding, they have taken interest, and they did a positive note or positive deal for more than 8,000 startups. So total funding amount in last year was 9.94 billion US dollars, and number of active investors, considering angel investors and VCs, the number was 1,476. So this is a quick snapshot of last year funding, 2020 funding. So top three sectors where investors took interest. Now we have seen the, you know, advertisements of different edutech platforms. 6 साल का बच्चा coding सीखेगा kind of advertisements. Last year we are watching similar kind of campaigns where edtech startups are coming in. Coursera, Udemy, Byju's, White Hat, even Pure Math is there. So there are n number of startups which are growing in edutech. Okay. Similarly, uh, today, see, for India, for our country, out of 40,000 startups, major contribution is of IT services, that is somewhere around 15%. And the next one is 9.5%, it's in healthcare sector. So healthcare sector is right now number two sector, which is attracting investors for funding. Considering this entire pandemic and crisis, even right now, this is the time where healthcare startups, which are blended with technology, they are attracting investors. And it is expected that edutech, health tech, and fintech, this will attract maximum amount or maximum number of deals in upcoming times to come. So top three cities considering recent funding trends. Number one, as usual, are Silicon Valley of India, 307 deals with $4.4 billion. Number two is Delhi NCR, 247 deals with 3.5 billion US dollar. And last, Mumbai, 170 deals with 1.2 billion US dollar. See, 68% of Indian startups, they are in these three cities: Bangalore, Delhi NCR, and Mumbai. So this is not, a part of surprise where we see these are the top three cities where we have these maximum deals. These are there since last 4 5 years, but we are expecting maximum number of startups, maximum number of deals in last year as well. So January to November 2020, last year, in entire year, through this 765 deals, we could initiate 8.5 billion US dollar as total funding. And so this was a 30% decline compared to the funding in 2019. So 2019 period was great for fintech startups, agri-tech startups, and healthcare startups. But considering uncertainty, considering challenges in assuming return on investment through investors perspective, the investment was low, 30% decline compared to the one which had in 2019. But the overall investor sentiments remained positive. And now these are the top three sectors. edutech, fintech, and health tech, where investors are taking interest. Now in India, VC investments they grew to 3.6 billion US dollar in July to September from 1.5 billion in the June quarter. So up till June 2020, the VC investment was with through 1.5 billion US dollar, but in next quarter it was raised to 3.6 billion dollar. Now, in upcoming year, now for this current year 2021, we are expecting maximum funding will be done for B2B type of business. So, in case if your business falls into that category of B2B, or even if you are into B2C, here is the time where, based on this trend, you need to think like how I can have one more revenue stream through this B2B channel, or B2B2G, or B2B2C. That can be another type of segment in your business model. So you can see like how you can initiate this B2B type as well in your existing business model, because this is the trend where B2B type of business is expecting more funding in this year. Impetus has already been given through Startup India Fund for healthcare and allied sectors. Now, when I talk about healthcare, see, I am not an engineer. I myself is a healthcare professional, so I have, this is where, or this is the sector which I have seen closely. So again, in healthcare sector, we have online pharmacy, health and fitness industry, or fitness and wellness industry is attracting investor thanks to all those cricket and Bollywood celebrities, because of them being an brand ambassador, as well as because of them as an investor. Healthcare startups, they are attracting this investment. So wellness and fitness and wellness being industry is there, then patho industry is there, then home healthcare is there, e-pharmacy is there, telemedicine is there, genetics is there, vaccine industry is there. So again, in healthcare sector, we have some 14, 15 subsectors. Okay. So even if you are one of the part of this healthcare ecosystem, you can be, have this favorable condition or favorable situation to attract the funding. Funding for startups will be mostly before healthcare, and this will be followed by transportation, education, and finance. So this is the average startup financing cycle, which we see right from we start our startup at early age. So initial level, we have the seed capital through our bootstrap, or through even which we get from incubation centers. So even once we have this break even, we can attract even angel investment up to 1 CR. And once you cross this break even, or once you have this initial customer traction for your segmentation or for your diversification, even you can raise the fund from venture capitalist or private equities. So even we have at certain stage, like for example at latter stage or second series or third series of funding, we have other options, like we can have this acquisitions, mergers, strategic alliances with other corporates or other startups. And this is how time versus revenue, it plays important role in as far as startup financing cycle is concerned. So these are the sources of startup phase funding. So till now, for Indian startup ecosystem. So you see 63% of the startups, they have, or they are self-financed. These are the startups which have been started through bootstrap, through their initial investment, through their own seed capital. Then 22% is, or these are the startups which have received the funding from banks. Next 9% is through state finance corporations, and nearly 3% for venture capitalists, and 3% for angel investors. So from this particular graph, or from this particular information, what we receive is, out of 100, only 6% startups are there who are attracting investments from angel investors and venture capitalists. I have seen many of the earliest startups or student startups. They are so confident that my idea or whatever innovation I have, I can easily get the funds from investors. I can easily attract angel investment, or I can attract VC funding for my startups. But one thing you need to understand, that out of 100, only 6 startups, they are attracting funds from angel investment and VC. So here what we understand is, attracting or getting funds from angel investors or VC funding is not that easy, but it's not that difficult as well. But yes, it is challenging process, and that's why we have such kind of session where you need to understand what are the expectations of investors, what exactly they look for in your startup, whether they are looking for idea, whether they are looking for your prototype, whether they are looking for what kind of problem you are solving, or whether they are looking for what is your market size, or maybe your team, or maybe your initial traction. So there are n number of things. So even when we start our startup, there are some 16 stages, from right from your ideation to your launch pad. So out of the 16 stages, where investors focus more. So because we have such trends, because we have such infographics with us, we right now know that only 6% startups are there who are actually attracting these funds. So if you want to be a part of the 6% of the startups, you need to be careful about their expectations, about their requirements, about their, what exactly they expect out of your startup. Is it ROI? Is it equity? Is it market side? What are those expectations? Okay, so we'll be talking more on that in this session. So these are some of the funding channels. Just in short, I'll be sharing you all these steps. Number one is bootstrap. So by using your own savings or from your family, friends, even you can have some co-founders. Even this is the space where I focus more on whenever I suggest or whenever I mentor any of the student startups or earlier startups, that startup cannot be always a one man army journey. Here you need to have some co-founder, a like-minded co-founder, and once he is coming in, you need to ask him for this seed funding or bootstrap. So as like how you as a founder, you are bootstrapping your startup. Similarly, if you are having one more co-founder, say for example you are an MBA and you are looking for a co-founder, so that co-founder should not be an MBA, that co-founder should be an engineer. So here he can handle entire technology part and you can handle entire operations and sales part. So this is how you have to complement each other, and this is how you need to build a team. So at least your early startup team should be of 4 to 5 people. So if 4 to 5 people are coming in one team, then each and every member of the team can bootstrap. And when you together bootstrap, whenever you together have your all savings and uh, entire money in your startup, it will be easy for you to get started, right? So your vision should be aligned, you should complement each other as far as your startup is concerned. Other than bootstrap, what other options we do have? So number one is crowdfunding, number two is angel investors, number three is venture capitalist, and number four is public market. So based on this, you can attract a similar kind of funding, maybe in early age or maybe in growth stage. Okay, so we'll look into one by one funding channel. So crowdfunding is where we can explore all the internet platforms, crowdfunding platforms which are there, and we can connect not just in our city, but even not in our country, but we can connect to the people and we can have global opportunities. So even from you can attract funds from US, UK, Canada, Australia, Japan, wherever these people are there who are connected with these global platforms, and they are looking for how they can contribute to your startup. So maybe if your idea is something where you can have the social entrepreneurship aspect, where you can disrupt the entire market, you have the ability to disrupt the market, at that time you can have this crowdfunding platform. So there are multiple benefits for this crowdfunding, and even I'll share you some of the best platforms, best crowdfunding platforms in our country. So it can basically generate interest and it helps in marketing the product alongside the financing. Okay, so there are some of the example, but let's have a look into the case study. So Rohil Dev, he is the founder and CEO of RHL Vision Technologies, and in 2012, when he was an engineering student in Kerala, for his Bluetooth ring, he could manage to raise $2 million funds in 60 days, and that too from 1,600 investors from 60 to 70 countries. So for one product which he has innovated, which has developed, he could, you know, ideate or he could announce that he is looking for a crowdfunding, and he could manage 2 million US dollars from 1,600 investors. So this is basically the potential of crowdfunding. So this you can, even many of the things or many of the innovators I have seen, they don't disclose their idea. They think that if I am disclosing or if I am announcing my idea, my product on such kind of crowdfunding platform, anyone can copy my idea and he can replicate this and he can have his own startup. See, we have something called as IPR, and you can always get benefit to protect your idea, to protect your innovation. So if you feel that your idea cannot be replicated or that should not be replicated, then you can have this IPR. But make sure that unless and until you announce or unless and until you share your idea, you share your innovation, you cannot attract such kind of investors. So be it crowdfunding or be it any other angel investment or VC funding. So these are 9 crowdfunding sites in India that are shaping the way which ideas and startups grow. So Kickstarter is there, Wishberry, Indiegogo, Fuel a Dream, Fundable, Keto, Catapult, then Milab. These are some of the 9 crowdfunding sites which you can use. You can just Google it and you have to just click on a button, start a project or submit an idea. So based on that, you have to share all your inputs of your startup, and then you can expect some of the crowdfunding from market. So far, equity crowdfunding is illegal in India. So for example, if you have shared something and you are attracting, say for example, $50 million from crowdfunding, in that way, if I am visiting $5 million, I cannot ask you to give me the equity. Like how I can ask you for being an angel investor or being a VC. So equity crowdfunding is completely illegal and it is unauthorized and unregulated by SEBI. Okay. Next is angel investors. So angel investors are the one who are individuals, who are not companies, who are individuals. And if 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 they cracked your idea, if they cracked your startup, then they are ready to invest whatever is the amount. So it ranges from 10 lakh to 10 CR based on your investment required, based on the equity which you are offering. So there are some advantages as well as disadvantages of getting the funds from angel investors. So angel investors are more interested into early age startups because at early age startup, you have not diversified or you have not your portfolio, complete portfolio at initial part of time where you have focus is only on the niche product or niche market. And at that time, the investment as compared to VC funding, the investment is sorry, as compared to growth stage, the investment required at early stage is low. So that's where you can connect to angel investors and you can have these investments. So the best example for angel investment is Ashish Gupta. So he is basically considered as lucky mascot because wherever he has invested, that startup has boomed like anything. And the best example is Flipkart, right? So in 2009 he invested 10 lakh rupees in Flipkart, which was started by Sachin and Binny Bansal, and that was the time where they wanted to have an early age investment, and at that time Ashish Gupta has invested 10 lakh rupees, and at the time of exit in 2016, this equity or this 10 lakh rupees investment has become 20 million US dollars. So you can imagine, you can calculate how much amount or how much interest rate is there as far as return on investment is concerned. So all investors are talking only one language, that is ROI. If I am investing 10 lakh rupees, tell me the ROI, tell me your market size, and based on that I can assume ROI after 3 years, after 5 years, after 7 years. So the exit policies are clear there. So he is the one, Ashish Gupta, who have invested in startups like Flipkart, Mu Sigma. Even he has co-founded Hellions Advisors, and he currently serves multiple startups including Naukri.com, Simply Learn, SMS Gupshup. And his past investments, this include Daksh, Make My Trip, even Redbus, Upwork. Next is VC funding. So whenever you require more than 10 CR, whenever you require more than what what you cannot get from investors, that time you can attract VCs. So VCs, see, unlike individuals, VCs are basically organizations which see your potential, see your startup potential, see your innovation portfolio, and based on that, they take a call whether to invest or not. So again, as like angel investment, there are, yes, some of the advantages are there, some of the disadvantages are there. These are some of the top VCs of India right now, including Ceph Partners, which has funded to Paytm, Swiggy, An Academy, Urban Company, Misho, ShareChat, Vigo, No Broker. So Save Partners is one of the topmost VCs in India, venture capitalist. Next is Bloom Venture, which has invested into An Academy, Dunzo, Healthify Me, then Great, HR, Milk Basket, Taxi for Sure. Next is Chirate Ventures. It has so far backed 80 plus companies, including Flipkart, Myntra, Cropin, First Cry, Healthify Me, Lenskart, Nestaway, Policy Bazaar, Yatra.com. And last is Nexus Venture Partners. So this includes Delivery, Dhruva, Unacademy, Postman, Rapido, Snapdeal, Zolo, White Hat HR, Zomato. So these are the top venture capitalists of India and their entire portfolio. So as far as VC funding is concerned, they basically operate in three stages. So series one, two, three, or series ABC funding. Okay. So series A funding is basically at seed stage, which is, when a startup require a funding for innovation, research and development, market research, or even maybe hiring their first employees. So at that time, the deal flow, maximum deals are there, but the deal value is low. See, you can understand even from this picture that series A funding is for seed stage, okay, where the number of deals are more, because see, investment is low here. That's where number of deals are more. For example, if I am a VC, then I can, and suppose I have some 100 CR funding which I wanted to fund to all these startups. So what I'll do is I'll have two options. If I have 100 CR, then I'll have two options. Either to invest 100 CR at on a startup which is at late stage or which is at growth stage, where I can see the traction, I can have maximum equity there. So that is option number one. Or option number two is, by using same 100 CR, I can invest to 10 different early age startups, 10 CR each, where the risk is maximum, where the returns are not guaranteed. But yes, the deal value is low, only 10 CR, but the number of deals would be more. So even out of 10, even if one startup has, you know, disrupted everything, and that considers a higher stage or higher growth in upcoming times to come, then I can get maximum returns from this particular equity. Okay. So number two is series B funding or series 2 funding, where the funding is being used for sales, marketing, manufacturing, where deal value is also moderate and deal flow is also moderate. And last is growth stage, where you can see the seed has become a plant, where you can see series C funding or series 3 funding, where we see all these startups like Zomato, Byju's, these are now in series C funding. Once they're done with even Oyo, once they're done with series C funding, the next stage for them is to have a strategic alliances or mergers and acquisitions, and then they will, enter into IPO. Okay, so that's the target, that's the goal which every startup they have. They start with seed stage, they start with early stage, later on they get sent to growth stage, and later through the strategic partnership, attracting maximum VC funding or funding cycles, then they reach to this IPO. So for late stage, the funding is being used for diversification, where you can diverse, where you can expand your product or your entire business, and market research. Now, number two uh, is why investors invest. See, understand their psychology. See, for even when you prepare your investors pitch deck, before you prepare your pitch deck, before you invest your time and energy on your pitch deck, you have to first understand his mentality. You have to understand first his psychology, right? You have to be in his shoes to understand or to get all these things through all these aspects. Okay, so why investors invest? So the simple answer is return on investment. See, if I want to invest in something, what I'll rather expect out of this is return on investment. So I have multiple options. Say, for example, I have 100 CR. So earlier, I used to invest in real estate. I used to invest in gold. I used to invest in banks. I used to invest in stocks and share market. But today, I have a certain ecosystem with me on which if I'm investing, yes, the risk is higher as at higher side, but the returns are maximum. We have seen a case study of Ashish Gupta where he has invested just 10 lakh rupees, but see how much ROI he has received in just 7 years. So I have to first compare whether if I am investing in startup, I have to compare all these startups or all these investments, and based on that, first I'll assess this risk. Okay. So all these investors, they are talking uh, through only one language, and that is ROI language. So first of all, they compare all the investment options, all the startup options. Then they assess, they analyze this risk, and then they calculate. They have these assumptions on returns. Okay. So this is the only expectations which investor have, that is return on investment. But apart from that, there are multiple things or multiple keys through which you can have this understanding of this approach. So there is a concept of risk return. See, whenever the risk is higher, there are higher chances of getting the returns and vice versa. Okay. So even if I have this bank deposits, I know I'll never, lose my money, but I can get maximum 5% returns on any of these banks, FDs, or any of these schemes, whatever are there in banks. So now I know that yes, the risk is minimum, but in that case, because the risk is minimum, the return is also minimum. So for me, if I am expecting higher returns, then I have to take higher risk, and that's where startups come in picture. So startups, no doubt, they are risky businesses, because even investors know that more than 80% startups are failing. And if I am investing in such startup, which is basically a part of 80%, then I have to ruin this everything. So here the case is I have this psychology where the risk is at higher side, but there I can expect higher returns. See, one more thing, even I'll share you one case study as well. Here, you can get multiple benefits from the startups. Say, for example, there are some investors who look into investments only in healthcare. Because, see, these are the people who have seen this entire industry and market closely. So they know what are the trends or what could be the trends in upcoming times to come. And based on these trends, based on the market expectations, then they decide whether to invest or not. Okay. So these are some, like how we have super specialized doctors. Similarly, these are super specialized investors who look into the investments only in the precise area or in the precise sector. Okay. So here, for example, 1% equity on Paytm, say 6 years ago, that you might have bought at say 10 lakhs, you could have yield 150 CR today, making up for all the other nine companies. So here we have given this one example. For example, I have 10 companies. So the same example, if I have 100 CR, I cannot invest the entire amount on only one startup and get higher equities. Okay, so that could be a bad option for me because the risk is almost higher for that. To minimize this risk, what I'll do is I'll classify all or I'll bifurcate this entire amount and I'll arrange this amount for 10 different startups. Now I know that out of 10, at least one will have a success story. I know that out of 10, 9 will have this failure, but I'm focusing on only one. So even if I bifurcated my entire investment 10 lakh rupees to each startup for 10 startups, then I know that out of 10, one will be successful, and this one will give me highest ROI more than what I could have invested 100 CR to any of the startup. So this is the example of Paytm. So even if I had 1% equity on Paytm 6 years ago, then I could have 150 CR. by investing only 10 lakh rupees. So here the case is, even if I lose my money on those startups which I have initiated for 9 other startups, it is absolutely fine. But the returns which I'm getting from that one success story, from one successful startup, they are absolutely at higher range. Okay, so this is how they calculate this risk. This is how they calculate return. This is how they calculate ROI based on these sectors. So what investors exactly expect? So there are 6 different states, or there are 6 different expectations based on which you have to work on your pitch deck, on your attributes, on your team, on your initial traction, and at last on your entire team. Okay. So number one, what investors expect from you? Number one, a well-defined business model and business plan. Now, many of the students or many of the earlier startups, they get confused between business model and business plan. So business model is, see, even if you can Google this business model of Google, business model of Zomato, Swiggy, Paytm, you'll get that particular business model canvas, which we call as BMC. So based on that, you have to just create this uh, complete and customized business model plan, a business model canvas for your own startup. So once I see, as an investor, once I see your business model, I have that entire sheet in front of me. I'll have all the analysis, entire understanding of this business model canvas, and then I'll I'll have all those figures in mind. What is the investment and what could be the returns? Simple. So based on that, you need to invest more time. You have to brainstorm, and then you have to create this business model canvas, so where you will have all the aspects of your startup, and just by looking your BMC, I can understand what you are going to do, how you are going to do, and why you are doing all these things. Okay, so business model will give me entire clarity before I decide whether to entertain you or not. See, many of the times, uh, investors pitch deck, they are basically for 5 minutes or maximum 10 minutes, or even we know elevator speech deck that you need to complete your presentation within 60 seconds. So 60 seconds, how will you complete this invest or elevator pitch deck? Thanks to BMC. Even if you show this BMC to any of the investor, within 60 seconds, he can get complete idea about your business. Okay. So they are not at all interested about who you are, what is your qualification, from which university you are graduated. They are interested in your business model canvas. They are interested in ROI. They are interested in your revenue streams. Many of the startups, we have seen BMCs, many of the startups, earlier startups, you have only one revenue stream, primary revenue stream. That's it. See, as an investor, I at least expect 2 or 3 revenue streams. So even if one revenue stream is failing, even if one revenue stream is not working, you will have this buffer revenue stream. So you should have in your BMC, you should have multiple revenue streams. And this is what we expect, right? So this is the first and foremost investors perspective, that we expect a clear, concise, and complete business model canvas for your business, and then business plan. So here you need, like how we have this project report for 3 years, for 5 years. So this is how your business plan should be. Okay. So business plan is it should be basically a document where I'll have everything, right? Name of your startup, your team, from how much time you're working on this particular part, your company information, your legal foundation, almost every micro detail about your business. In next 3 years, considering whatever ticket size you have for your product or service, whatever market you have chosen, based on that, in next 3 years, what are your business propositions, right? How much investment you are looking for in the next 3 years, how much returns you are expecting from the next 3 years, how much net profit or net business you are expecting in next 3 years, how much team you are expecting in next 3 years. So you need a concise and complete plan and complete documentation in this business plan. So even if you have this business model canvas and business plan along with your investor pitch deck, your 50% work is done, right? So first, within a minute you have to first impress that investor, talking about your business model, talking about what pain point of the market you are solving, or what pain point you are actually disrupting from the market. So this is number one. Number two, your team. See, we have seen multiple earlier startups who come alone, and they are in an impression that I can do everything. I can do everything is, see, that approach is correct, but at early age where you are in a first stage of startup. See, ideally there are two stages of the startup. One is idea to prototype, and number two is prototype to product. Number one stage, it is acceptable that yes, you are the only one who will be working on this idea. Okay. But once you have a prototype and once you are moving to the second stage of the startup, that is prototype to product, yes, sorry, yes, you need to have a team. Okay. Now, even we have discussed how you can form a team. Okay. Now, in order to form a team here at initial level, you won't require any employee. So rather than employing someone, see to it how you can attract co-founders. So as I said, if you are an engineer, attract someone or have a co-founder who is not an engineer, who is basically MBA. If your startup is into agriculture, then find someone who is graduate in agriculture, who is biotech or he is biotech engineer. Have someone who is MBA, have someone who knows everything about legal. So these are the 3 to 4 people where you have to bifurcate all your responsibilities. One will look into operations, one will look into product development, one will look into sales and marketing, one will look into entire networking, legal, finance, everything. So you need to have a team. So when investor is looking into your business, the last thing which he look for, or based on that, then he decides whether to invest or not, it is your team. Many of the startups, they have great business models, they have great business plan, but they have weak team. So in case, even if you have something which you can disrupt, but still if your team is weak, if your team is not complete, then yes, then they, like how HR usually speaks to any of the job speakers, hashtag we will let you know. So in that way we understand that we have rejected. Similar kind of uh, expressions investors will give you, that we will let you know. Okay, so here you need to understand that you are lagging somewhere, and we will let you know is you are rejected. Okay, so make sure like how potential your idea is, how potential you have in your product, similar potential you need to have your in your team, their capabilities and their expertise. Number three, the market. Now the market is completely changing. Now the market is completely flexible, and investors are rethinking before they invest something on any of the startups, because the market is not constant, the market is flexible. So see to it that what is the current trend in the market. Like initially we have discussed that, considering today's market, healthcare startups, edutech startups, fintech startups, agri-tech startups, transportation startups, these are the market driven startups, or these are the startups, or these are the innovations, or these are the products or businesses which market is in a need of. Okay, so whenever you have this need based innovation, you need to see what are the trends in the market, like how you are looking at the requirements or expectations of the investors. Similarly, look into the expectations of the market, look into the requirements of the market, and based on that you have to create this particular approach where investors are more into what is your market size. Okay, so initially, for example, if your business is or if your business plan, it's into 3 phases: phase one, phase two, phase three. For example, if you are operating from Mumbai, in phase one, maybe you will be operating only for Mumbai market. Phase two, you'll be operating pan Maharashtra, and phase three, you'll be operating pan India. So based on that, as an investor, I have to calculate market size. And based on market size, what are the competitive advantages which you are going to get in next 2 to 3 years? Okay. So before your ideas are getting replicated by someone else, you need to have complete break even of your business, and you should give a complete ROI to the investors. So that's what investors expect as far as market is concerned. Next is the level of commercial traction. uh, Many of the startups, they are still in a prototype stage, and they think that yes, just by showcasing my prototype I can attract investors. No, 99% it didn't happen. Okay, even if you have a great prototype, even if you have a great working model, even if you have great business model and great team, yes, we are looking for at least initial commercial traction. Now, what is initial commercial traction? So, for example, if in January 2020, sorry, in January 2021, I have done with my prototype, I have my entire BMC done, I have my entire team with me, and I have not sold this product to anyone, or I have only, or I have zero customers. Now, as an investors, what we can suggest you here, in January, if you are completing your prototype, have or launch that particular product and sell it to initial customers. So January, February, March, in the next 3 months, what is your commercial traction? What are your sales strategies? What is the response from customer? What is his feedback? So based on initial 3 months cash flow, based on initial 3 months commercial traction, we are going to decide whether whatever you have created, is it acceptable by customers or not. That's it. We want only, or we want to ensure only that thing, whether whatever you have created, is it acceptable by customers? Is it acceptable by market? That's it, right? So see to it that at least 3 months cash flow should be there in your current account. So even if you show me your current account statement of last 3 months, say these are my customers, these are my initial traction, these are my feedbacks, yes, you can impress that investors, and then you can expect some of the good investment deals. Okay, so only prototype? No, maybe you are great in prototype, but I have to wait unless and until you will have initial 3 months commercial traction. And last, what X factor you have, what USP you have, what is your unique selling proposition, what is or what X factor you have, maybe in your team, maybe in your product, maybe in your customers, maybe in your market, maybe in your innovation. What is your X factor? Okay, and that X factor should be there, should be presented in front of investors. See, now all these things you have to, whenever we talk on how to create or how to prepare a pitch deck, we have to think all these aspects while creating this pitch deck. All these aspects, all these elements should be there in your pitch deck, and within 5 minutes you should express all these things to the investors, and based on that only they will entertain these earlier startups, or they will have interest in investments. Okay, so these are some of the expectations. And last, some of the quotes or some of the statements right from the investors, and then we'll get to know what are the absolute investors perspective. So number one, I invest because I love helping entrepreneurs and watching them learn and succeed. In my opinion, your motives are driven by self serving factors around ego, satisfaction, and making a buck. My motives and values are very different. See, your startup should be value driven. Your startup should be customer centric. You should care about solving customers' pain point. That's it. There are no other thoughts. So for you, investment should be secondary. Investors should be secondary. Making money should be secondary. No doubt, whatever we are doing just for the sake of making a money. But in that process, many of the startups, their first preference is making a money. And there in this process, they lose their customers. They lose their market. To avoid this, even investors' perspectives say that yes, your primary attribute or your preference should be your customer and solving their problems. Number two, smart tech investors, those who invest in technology, Smart tech investors think about number one, future product roadmap, number two, bottom up market size and growth, and number three, talent and skill of the team. That is essential, talent and scheme of team. So essentially, you are valuing things that have not yet happened and the likelihood of the CEO and team being able to make them happen. So finance people find this appealing, but investors who do this well can make a lot of money. Okay, that is number two. Number three, wait until companies have an initial prototype. Now, this is where investors suggested to other investors. Wait until startups, wait until companies, they have initial prototype. They have shown that they have the potential to be profitable and have the ability to scale. That's the best time to invest. Ability to scale. I mean, here is the point where investors, they have suggested investors to wait till the companies they have initial prototype, till the companies they sell this prototype to at least 300 teaching customers. We call them teaching customers, the strangers, and at least in 3 months they should have this initial commercial traction. Based on that, or yes, based on that, we can sense whether it is profitable or not. Then that's the best time to invest. Rather, that's the best time to decide whether to invest or not. The business model piece is we are always talking about competing more effectively. If you are starting a company or career, you don't want to compete. You want to create a monopoly. We want to invest in a company that has a good plan to create a monopoly. So there are two markets. There are two markets. One is blue ocean and one is red ocean. For you as an earlier startup, for you as an innovator, for you as a startup founder, initial traction or initial your early A startup journey for the next 2 to 3 years, you should be a part of this blue ocean. You should have that monopoly. And when we as an investor know that, yes, this is the one where you are a part of blue ocean, then your chances of getting funds are more. That's why you need that X factor. And last, I look at two things while angel investing. Number one, are you solving an important customer problem? And number two, do you care about the end users? Do you care about the consumers? So these are the two important things which uh, Gary Vee, he basically look into while he invests as an angel investor. Okay, so these are some of the perspectives, absolute perspectives from the investors. So with this, I conclude this session, and once again, I'm thankful to MIT team for having me here for this investors perspective session. And before I sign off, uh, I'll just want to share one thing, that you even can be a part of a startup community which we have started, which is basically a free platform for all the startups, all the professionals, all the freelancers, all the students, all those who want to know everything about startup. Okay, so I'll share all the details to MIT eCell members, MIT eCell committee, so that they can share you during this entire eSummit program. You can be a part of this startup community. Once you join, you can get all the information, all the updates related with startups, related with investors, related with all the activities, workshops, conferences, free programs for all the startup professionals, so that you can benefit this. These are my contact details in case if you want to uh, have an interaction based on any difficulty in your startup, maybe from ideation to your launchpad, whatever stages we have, then we are there to help you. Basically, as a part of Startup Accelerator, we are already connected with incubation centers. So even if you are in a requirement of funds from incubation centers, or even from investors, we are connected with uh, angel investors, we are connected with VCs, we are connected with incubation centers, consultants, freelancers, developers. So you can reach us at any time. Our website is www.opexindia.com. So with this, I'm Sachin signing off. And once again, thank you so much to all the organizers, and thank you so much to all the entire audience for having me here for this wonderful session. Thank you so much.